Okay, so you've all really outdone yourselves this time. You've sent in a ton of stuff about, the economy and the markets and all this talk about a possible recession in 2025 and what it could mean for your money. We're
Right.
talking everything from like detailed economic analysis to like expert predictions, articles, excerpts, all centered around this big question. Could we actually see a stock market crash that like triggers a wider recession?
Yeah, and how would that impact, everyday people? That's a big one.
Exactly. So today we're going to really like dive deep into all of this stuff. We're going to be talking about inflation, the Federal Reserve, global events, and what it all means for you and like your financial well-being. Our goal here is to like really cut through the noise and give you the key insights from everything you sent without getting bogged down in the jargon.
I like to think of it as like we're giving you the cheat sheet to being truly informed about this stuff. You get to skip all the boring bits and just get the good stuff.
Exactly. Okay, so let's jump right into it. One thing that really jumps out from the material you sent is this whole issue of inflation. It's been sticking around for a while now, hasn't it? It seems like it's a really tough problem to solve. And the Fed's main response has been to raise interest rates,
Hmm.
basically making it more expensive for everyone to borrow money.
Right. So it's kind of like hitting the brakes on the economy, When borrowing costs go up, people might think twice about buying a house or a car. Businesses might hold off on expanding, and in theory, the slowdown in spending should eventually help to bring those prices down.
But the sources also point out that slowing things down too much could actually trigger the very recession everyone's worried about, right?
That's the tricky part. It's all about finding that balance. Your sources highlight this idea that the Fed has to be really careful not to overdo it. Too much braking could send us into a tailspin. And then there's this other thing, too. With inflation being so persistent in certain areas, like services, it's making some economists think the Fed might have to keep interest rates higher for longer than anyone initially expected. And that could really increase the chances of a sharper slowdown.
And speaking of potential red flags, your sources keep mentioning something called the inverted yield curve. Now, I know that might sound a little intimidating, but stick with me. It basically means that short-term government bonds are offering higher yields than long-term bonds. And historically, this has been a pretty reliable signal that a recession might be coming.
Yeah, and what's really interesting about the yield curve? It's like a window into investor sentiment. Normally, you'd expect a higher return for lending your money out for a longer period because there's more risk involved, right?
More time,
Maybe.
more
Yeah.
uncertainty.
Exactly. So when those short-term rates are higher, it could mean that investors are more worried about the long-term prospects of the economy than the near future. Like they're anticipating a slowdown or even a recession down the line. Now, your sources do mention that the yield curve isn't a foolproof predictor. There have been times when it's inverted and we haven't had a recession. But still, it's definitely something to watch. If we were to see a stock market crash in 2025 and the yield curve was already inverted, that would be a pretty strong signal that those underlying fears about the economy are justified.
And it's not just what's happening here in the U.S. that we need to worry about, right? The global economic picture is getting pretty complicated, too. Your sources talk a lot about trade tensions, geopolitical instability, and predictions that global growth is going to slow down. All of that adds to the uncertainty.
Absolutely. When you have trade disputes going on, it disrupts those supply chains that we all rely on, and that leads to higher costs for businesses, which often get passed on to consumers. And then you've got the geopolitical side of things. Conflicts and political instability in different parts of the world can really spook investors and make the markets more volatile. Energy prices can spike, commodity prices can jump around. It's a recipe for uncertainty. And if the global economy as a whole slows down, that's going to have an impact here in the US too, especially for companies that do a lot of business overseas.
Yeah, your sources even mentioned that a big U.S. investment by a tech company, which sounds like a positive thing on the surface, could actually have some geopolitical ripple effects too. Like it could be seen as a defense strategy or way to shift power dynamics in a certain region.
Hmm.
Just shows how interconnected everything really is.
Exactly. You can't really separate the economic picture from the geopolitical one these days. They're totally intertwined. And that adds another layer of complexity to everything.
And then there's the housing market, which has been pretty wild the last few years, with prices skyrocketing in many parts of the country. But some of your sources are suggesting things might be starting to cool down. You've got high prices combined with those rising mortgage rates we talked about.
Yeah.
And that's making it a lot harder for people to afford homes.
Right. And that raises some serious concerns. For a lot of people, their home is their biggest asset. It's a huge part of their net worth. If house prices start to fall or even just flatten out, it can make people feel a lot less wealthy.
Yeah, less secure about their finances.
Exactly. And when people feel less wealthy, they tend to spend less. and that can have a ripple effect throughout the entire economy. It's actually very similar to what happened back in 2008. The housing market downturn was a major factor in that financial crisis.
Now, one bright spot has been the job market, which has stayed pretty strong overall. But your sources point out that there are some cracks starting to show. They talk about some sectors like tech and manufacturing that are starting to feel the strain. And they highlight some pretty alarming statistics. Job openings have fallen by almost 40% in just the past 2.5 years.
Yeah, and a 10% drop in just the last year alone, that's a pretty significant decline. It suggests that businesses might be getting more hesitant about hiring.
And we're also seeing an increase in continuing unemployment claims. So it's taking people longer to find new jobs once they've been laid off.
Right, and that's a sign that the job market might be starting to weaken. And when the job market weakens, people have less money to spend, which can further slow down the economy. So even though the overall unemployment rate might still look pretty good right now, these trends in job openings and continuing claims are definitely something to keep an eye on.
It seems like we've seen some of these patterns before, haven't we? Your sources do a good job of connecting the dots to past economic crises. They talk about how stock market crashes are rarely isolated events. We've got the 2008 financial crisis, which, as we just talked about, was heavily tied to the housing market. There's the dot-com bubble burst back in 2000, and of course the 1929 crash that led to the Great Depression. What lessons can we learn from these historical events that might be relevant to what could happen in 2025?
I think the biggest takeaway is that everything is connected. The financial system, the economy, global events, investor psychology, it's all intertwined. A shock in one area can quickly spread to others and create a domino effect.
Right, like a chain reaction.
Exactly.
Right.
And we've seen how investor fear and uncertainty can really amplify those downturns. So it's a reminder that we can't just look at the stock market in isolation. We need to understand the broader context. The historical parallels are really valuable for that.
Mm-hmm. So with all these potential warning signs out there,
Yeah.
what are the experts actually saying about 2025? It seems like your sources present a real mix of opinions. Some economists are still pretty optimistic. They point to some underlying strengths in the economy. But others are definitely sounding the alarm bells about inflation, interest rates, and the possibility of a big market correction.
Yeah.
And then there's all this talk about a soft landing.
Yeah, the soft landing is the holy grail right now. It's the idea that the Fed can somehow manage to bring inflation down without causing a recession. But it's a really tough needle to thread, like trying to land a plane on a runway that's covered in ice. It takes a lot of skill and a bit of luck.
Right. And it sounds like a lot of the experts that your sources cite are worried that the Fed's moves to raise rates, along with all the other risks we've talked about, could actually push us into a more serious recession.
Exactly. The fact that there's so much disagreement among economists just shows how uncertain the situation is.
So let's say a recession does happen in 2025. Your sources paint a pretty bleak picture of what that could look like. We're talking job losses, slower economic growth, businesses putting their plans on hold, consumers cutting back on spending. It's not a pretty picture.
No, it's not. And I think the examples that your sources bring up are really telling. They talk about how companies like Delta and United Airlines are already issuing warnings about the economic outlook. And there are reports of financial strain at major retailers like Target and Dollar General. These are real companies with real data showing that things might be heading in the wrong direction.
Yeah, and it's not just anecdotal evidence. The data backs it up.
Yeah.
You mentioned the low personal savings rate, only 3.8%. And we're seeing declining retail sales figures, too. It suggests that a lot of people are already struggling financially, and they might not have a lot of cushion if the economy takes a turn for the worse.
Right. It all adds up to a sense that the economy is vulnerable right now.
Okay, so let's talk about tariffs. This is something that your sources really dig into, and it seems like a pretty complicated issue. The basic idea is that you put a tax on imported goods to try to protect domestic industries. Make those products made here in the U.S. more competitive. Your sources even bring up that historical example of the tariff on pickup trucks back in the 1960s, which led to more U.S.-based manufacturing.
Yeah, and that's the main argument in favor of tariffs, right? You try to boost domestic production, create jobs here at home, and maybe even generate some extra tax revenue for the government. The idea is that by making imported goods more expensive, you encourage people to buy American.
But of course, there's a potential downside, too. Your sources don't shy away from that, especially when it comes to inflation. If you make imported goods more expensive, those costs often get passed on to consumers.
Exactly. And that means higher prices for everyone. Your sources use the example of a vacuum cleaner becoming more expensive because of tariffs. It's a really concrete illustration of how tariffs can hit consumers in the pocketbook.
And there's another important point, too, about global competition. Some countries like Bangladesh have much lower labor costs than the U.S. So even with tariffs in place, some U.S. industries might still struggle to compete on price. And that means consumers could end up paying more for goods that are essentially the same.
It's a really complex issue. The economics of tariffs are not straightforward. Your sources point out that even though it's technically a tax on the foreign producer, it often ends up being the American consumer who bears a significant part of the cost through higher prices.
And it's not just about the economic impact either, right? There's a big political dimension to tariffs, too. Your sources talk about how Congress has the power to impose tariffs, but there are exceptions for things like national security or unfair trade practices. And even if a tariff is proposed, like that 10% tariff that's been floated around, it doesn't mean it's going to happen. It could face a lot of opposition.
Right. And then there's the potential for retaliation from other countries. If we slap tariffs on their goods, they might retaliate with tariffs on our exports. And that could hurt U.S. businesses and lead to even more price increases for consumers.
So it really boils down to this big question: do the potential benefits of tariffs outweigh the risks? That's a tough one.
Yeah, there's no easy answer. Economists have been debating this for decades. Your sources do a good job of highlighting the complexity and uncertainty surrounding tariffs.
Okay, so beyond tariffs, your sources outline a whole bunch of other factors that are adding to this sense of uncertainty in the markets. Let's start with the Fed. We already talked about how they've been raising interest rates, but the sources really dig into how those rate hikes can ripple through the whole economy, affecting borrowing costs for individuals and businesses, impacting investment decisions, and even putting pressure on stock prices.
Yeah, the Fed's actions have a huge impact on the financial markets in the broader economy. When interest rates go up, it becomes more expensive to borrow money for everything from mortgages to business loans, and that can slow down economic activity. Higher interest rates also make bonds a more attractive investment compared to stocks. So investors might start shifting their money out of stocks and into bonds, which can push stock prices down.
And if inflation stays high, the Fed might feel like they have to keep raising rates even more.
Right. And that could make things even worse for the stock market.
All the geopolitical instability happening around the world. All the conflict, supply chain disruptions, the risk of oil price spikes, even concerns about cyber attacks and trade wars. It's a lot to worry about.
Yeah, and all of that uncertainty makes investors nervous. They start pulling back from the markets, which can lead to further declines.
And your sources talk a lot about predictions of slower global economic growth and even a possible worldwide recession. That's a scary thought.
Yeah, if the global economy slows down, it's going to have a ripple effect everywhere. Demand for goods and services will fall, businesses might start laying people off, and stock prices could take a hit. It's a recipe for trouble.
And companies are facing a lot of pressure on their earnings right now, too. Rising labor costs, supply chain problems, tighter lending conditions. If they start reporting disappointing earnings, especially with the market valuations as high as they are, could we see a big market correction?
It's definitely a possibility. When stock prices are high, it means investors are expecting companies to keep growing their earnings. But if those earnings start to disappoint, investors might get spooked and start selling their stocks, and that can lead to a rapid decline in prices.
And your sources highlight those metrics that show that both the stock market and the housing market seem overvalued right now. That equity to GDP ratio and the high price to rent ratio in housing, it's like a bubble waiting to burst.
That's a good analogy. A bubble can keep inflating for a while, but eventually something pricks it and it pops. And that's what we're worried about. A sudden shift in sentiment, a piece of bad news, anything, could trigger a sell-off.
And of course, the market itself can be pretty unpredictable. It's driven by investor psychology as much as by anything else. High volatility and sudden changes in sentiment can lead to huge price swings.
Absolutely. Fear and greed are powerful motivators, and they can really distort things in the short term.
And your sources also bring up this concern about a potential bubble in the tech sector. We've seen some really rapid growth in tech stocks over the past few years. But what if that growth starts to slow down or even reverse? Could we see a repeat of the dot-com bubble burst?
It's definitely a risk that investors are thinking about. Any sector that experiences very rapid growth is susceptible to a correction. And if investor sentiment turns negative, it can happen very quickly.
And then there's the whole issue of rising global debt levels. Your sources point out that this could create some systemic risks in the financial system, especially if interest rates stay high. That sounds pretty worrying.
Yeah, high levels of debt can be a real problem. When interest rates go up, it becomes more expensive to service that debt. And if borrowers start defaulting on their loans, it can trigger a chain reaction that spreads throughout the financial system. It's one of those things that keeps central bankers up at night.
And speaking of things that keep people up at night, your sources really hammer home the point about investor psychology. You know that fear of a recession can actually become a self-fulfilling prophecy. We've already seen some pretty big drops in major stock indexes, like the S&P 500 and the Nasdaq Q100, and individual stocks like Nvidia, Tesla, Palantir, and they've all taken a hit recently. It seems like investors are getting really spooked.
Yeah, and the fear and greed index that your sources mentioned is showing extreme fear right now. That tells us that investors are really nervous about the future, and when fear takes over, it can drive the market down even further.
Okay, so let's say you're listening to all of this, and you're starting to get a little bit anxious about your own finances. What can you actually do to protect yourself? Your sources offer some pretty good advice. They talk about diversifying your investments, building up a cash reserve, focusing on high-quality investments, and even using risk management tools.
Right. Those are all really solid strategies for navigating uncertain times. Diversification is like the old saying, don't put all your eggs in one basket. It helps you spread your risk across different types of assets so that if one area of the market takes a hit, your whole portfolio doesn't go down with it. Having some cash on hand is also really important. It gives you a cushion if you lose your job or have an unexpected expense. And it also gives you the flexibility to invest if the market drops and prices become more attractive.
Right. You can buy low and hopefully sell high later on.
Exactly. And then there's the idea of focusing on high-quality investments. That means companies with strong financials, a proven track record of profitability, and a solid competitive position in their industry. These companies are more likely to weather a recession and come out stronger on the other side.
And your sources also mention some specific risk management tools that investors can use, things like stop-loss orders and options.
Right. Those are a little more advanced, but they can be really helpful for limiting your potential losses if the market takes a downturn. Stop loss orders automatically sell your stock if it falls below a certain price. And options can give you the right, but not the obligation to buy or sell a stock at a specific price in the future. They can be a little complicated, but if you're comfortable with them, they can be a valuable tool for managing risk.
And it sounds like now is a good time to just take stock of your overall financial situation. You know your sources recommend listing out all your assets and debts so you have a clear picture. Really understanding where your money is going by reviewing your spending habits, maybe going back through a few months of bank statements, and categorizing everything.
It's like giving yourself a financial checkup. You want to make sure everything is in good working order.
Exactly. And then you can start to identify any areas where you can cut back on spending. Those non-essential expenses that are draining your budget. And once you've freed up some cash, you can start automating your savings and investments as much as possible. Setting up automatic transfers from your checking account to your savings account or investment account. And make sure you're taking full advantage of your employer's 401k match if they offer one. That's free money.
It's amazing how much of a difference those small steps can make over time. The power of compounding is incredible. Even small amounts of money invested regularly can grow into a significant nest egg over the long term.
And your sources even suggest looking into target date funds as a way to simplify your investing. Those funds that automatically adjust their asset allocation as you get closer to retirement.
Yeah, those can be a good option for people who don't want to spend a lot of time managing their investments. They're kind of like a set it and forget it approach.
And if you're looking to boost your income, your sources recommend exploring things like negotiating a raise at your current job or looking into side hustles to generate some extra cash.
Yeah, those are both great options. Negotiating a raise can be intimidating, but it's worth a shot. If you've been doing a good job and exceeding expectations, you deserve to be compensated accordingly. And side hustles are a great way to earn extra money on your own terms. There are so many opportunities these days with the gig economy and everything.
Now, it's really important to make a distinction between investing and speculating, isn't it? Your sources do a good job of explaining the difference. Investing is about long-term growth, while speculating is more about trying to make quick profits by timing the market or betting on short-term price movements.
It's a really important distinction. And the advice from your sources is clear. Don't rely on speculation as your primary way to build wealth. It's too risky.
Yeah, it's like gambling. You might get lucky in the short term, but over the long term, the odds are stacked against you.
Exactly. For most people, a sound investment strategy should be built on a foundation of diversified long-term investments. Things like index funds, ETFs, real estate.
Your sources recommend investing in a broad range of reliable funds, like S&P 500 index funds or broad market ETFs, and doing it consistently over time. That concept of dollar cost averaging comes up a lot.
Yeah. Dollar cost averaging is a really great strategy. It helps you smooth out the ups and downs of the market and avoid making emotional decisions. You just invest a fixed amount of money at regular intervals, regardless of what the market is doing. It takes the guesswork out of it.
It's like putting your investing on autopilot.
Exactly. And it's a really effective way to build wealth over time.
And your sources also emphasize the importance of understanding your own risk tolerance. You know how much volatility are you comfortable with? What are your financial goals? What's your time horizon? Once you understand those things, you can start to build an investment strategy that aligns with your individual needs and circumstances.
Right. There's no one-size-fits-all approach to investing. It's all about finding what works best for you.
Now, it's interesting that your sources also caution against getting too caught up in trying to predict the future. There have been so many predictions, especially after the pandemic, that just haven't panned out.
Yeah, it's really tough to predict what's going to happen in the economy or the markets. Even the experts get it wrong all the time.
So the advice seems to be to learn from history, but don't obsess over trying to time the market.
Exactly. Focus on building a diversified portfolio that's aligned with your risk tolerance and your long-term goals, and then just stay the course. Ride out the ups and downs.
And the sources really advocate for a long-term perspective on investing. Don't get distracted by the short-term noise.
Right. Time is your greatest ally when it comes to investing. The longer you stay invested, the more opportunity you have for your money to grow. It's all about patience and discipline.
And they also talk about the importance of embracing average returns. Don't try to chase those high-flying stocks or risky investments that promise to make you rich quick. It's more important to build a solid foundation with broad market exposure.
Exactly. Index funds are a great way to do that. They give you exposure to a whole basket of stocks, which helps to diversify your portfolio and reduce your risk.
And while alternative investments like hedge funds or private equity might sound alluring, your sources suggest that they shouldn't be the core of your investment strategy. Stick to the basics, things like stocks, bonds, real estate.
Yeah, those are the building blocks of a solid portfolio. They're well understood, they're relatively liquid, and they've got a long track record.
And your sources really stress the importance of utilizing tax-advantaged retirement accounts like 401ks and IRAs. And they also talk about keeping your investment costs low by choosing low-fee funds.
Yeah, those are both really important considerations. Tax-advantaged accounts can save you a lot of money in the long run, and those high fees that some funds charge can really eat into your returns. It's important to be mindful of those costs.
Okay, so one of the more intriguing ideas that comes up in your sources is this concept of a Trump effect. The idea is that some of the policies that have been implemented or proposed, like tariffs and questioning traditional alliances, might be intentional strategies to pressure the Fed to lower interest rates. The thinking is that the national debt is a big concern, and lower rates would make it easier to manage that debt.
Yeah, it's an interesting theory. And it's certainly possible that those factors are playing a role in the decision-making process. But it's also important to remember that there are a lot of other variables at play. And the motivations behind policy decisions are often very complex. It's hard to know for sure what's driving things behind the scenes.
And it's not all doom and gloom either. Some of your sources offer a more optimistic view, suggesting that maybe the fundamentals of the economy are actually stronger than the recent market drops would suggest.
Yeah, there are some economists who believe that the market has overreacted to the negative news and that we could see a rebound in the second half of 2025. They point to factors like strong consumer spending and a healthy job market as reasons for optimism.
And they make a good point about how the best trading days often happen when you least expect them. If you try to time the market and sell everything when things are looking bad, you could miss out on those big rallies.
Exactly. It's often better to just stay invested and ride out the volatility. Time in the market beats timing the market.
And your sources also talk about some potential safe havens for investors during times of economic uncertainty. Gold is one that comes up a lot. It's often seen as a store of value that can hold its worth during times of turmoil.
Yeah, gold has historically been a popular hedge against inflation and economic downturns. It's a physical asset that's not tied to any particular currency or government. So some investors see it as a safe bet when things are looking uncertain.
And defense stocks are another area that's seen some interest lately. With all the geopolitical tensions around the world, some investors are betting that defense spending will increase.
Yeah, that's a common trend during times of geopolitical instability. When there's a perceived threat, countries tend to increase their military budgets, and that can benefit defense contractors.
Okay, so we've covered a lot of ground here today. We've talked about inflation, interest rates, the global economy, tariffs, historical patterns, expert opinions, and all sorts of potential market reactions. It's been a whirlwind tour of the economic landscape.
Yeah, and the sources you send in really highlight the complexity of the situation. There's no easy answer to the question of whether we'll see a recession in 2025. There are valid arguments on both sides.
But I think the most important takeaway from all of this is that even in times of uncertainty, there are things you can do to protect yourself and even potentially profit from market fluctuations. The key is to have a plan to be informed and to stay disciplined.
Absolutely. Don't panic. Don't make emotional decisions. Stick to your long-term investment strategy, and you'll be much better positioned to weather whatever storms may come.
So here's a final thought for you to consider as you go about your day. With all the conflicting signals we've discussed, what's the one economic indicator that you're going to be watching most closely in the coming months to get a sense of where things are really heading? What will be your personal canary in the coal mine? Thanks for joining us for this deep dive.
Restful riches, they're floating up high. Passive income steady, no need to ask why. Wealth is growing with each move you make. Invest with wisdom, don't hesitate or break. Educate yourself, don't settle for less. Get that knowledge, be your own success. Set yourself free, let the money flow. Stress-free living, that's how you grow. Restful riches, it's the life you'll see. Passive income, it's your destiny. Time for you to rise, leave the debt behind. Success is easy with the right state of mind. Stocks or real estate, make the right call. When you're educated, you can have it all. Long-term growth, let the patience be your guide. Watch your wealth build with each stride. Paying down debt, that's the first thing to do. Put your future in focus, make it shine through. No stress, no rush, just take your time. Wealth building's a rhythm, so let it rhyme. Restful riches, it's the life you'll see. Passive income, it's your destiny. Time for you to rise, leave the debt behind. Success is easy with the right state of mind. Every step you take, you're making it right. Peace of mind and the future's so bright. Building with patience, knowing you're free. Wealth is yours, just wait and see. Restful riches, it's the life you'll see. Passive income, it's your destiny. Time for you to rise, leave the debt behind. Success is easy with the right state of mind. Restful riches building high, live your dream, reach for the sky. Passive income, wealth on your side. Stress-free living with your heart open wide. Diversify, don't put all in one. The path to wealth is a journey begun. Crypto's dividends and bonds that yield multiple streams, your future sealed. Consistency is key, let time be a friend.